A Random Walk Down Wall Street is a book written by Burton G. Malkiel, first published in 1973 and revised periodically. The book challenges traditional investment strategies and advocates for a passive investment approach based on the efficient market hypothesis. Here is a summary of the key concepts covered in A Random Walk Down Wall Street. Efficient market hypothesis. In Malkiel introduces the concept of the efficient market hypothesis, which states that financial markets are efficient and incorporate all available information into stock prices. According to this theory, it is difficult to consistently outperform the market through active stock picking or market timing. Random walk theory. The book presents the idea that stock price movements are essentially random and unpredictable in the short term. The implication is that trying to time the market or predict future stock price movements is futile. Passive investing. Malkiel advocates for passive investing through index funds or exchange-traded funds, ETFs. These investment vehicles aim to replicate the performance of a market index, such as the S&P 500, rather than trying to beat the market. By investing in a broad market index, investors can capture the overall market return and benefit from diversification. Modern portfolio theory. Malkiel discusses the principles of modern portfolio theory, MPT, which emphasizes the importance of diversification and asset allocation. MPT suggests that by combining different types of assets with varying risk and return characteristics, investors can optimize their portfolios to achieve a desired level of risk-adjusted returns. Market bubbles and investor behavior. The book explores the phenomenon of market bubbles, where stock prices become significantly detached from their intrinsic values. Malkiel discusses the irrational exuberance and speculative behavior that often lead to bubbles and subsequent market crashes. He warns against succumbing to herd mentality and making investment decisions based on short-term market trends. Fundamental analysis versus technical analysis. Malkiel compares fundamental analysis, which involves evaluating a company's financial health and future prospects, with technical analysis. He argues that fundamental analysis has more long-term value in identifying good investment opportunities. Long-term investing. Malkiel emphasizes the importance of taking a long-term perspective when investing. He advises against trying to time the market or make frequent trades, as the transaction costs and potential errors can outweigh any benefits. Behavioral finance. The book delves into the field of behavioral finance, which combines psychology and finance to understand how cognitive biases and emotions affect investment decisions. Malkiel explores common biases such as overconfidence, loss aversion, and herding behavior, and suggests ways to counteract them. Asset allocation and rebalancing. Malkiel discusses the significance of asset allocation and rebalancing in maintaining a well-diversified portfolio. By periodically adjusting the portfolio to maintain the desired asset allocation, investors can manage risk and potentially enhance returns. In summary, A Random Walk Down Wall Street challenges the notion of consistently beating the market through active investing strategies. It promotes the idea of passive investing, diversification, and a long-term approach to achieve steady and competitive returns. The book also explores the impact of behavioral biases on investment decisions, emphasizing the importance of disciplined and rational thinking in the face of market fluctuations.